Hey, what's going on, YouTube, and welcome back to Tech Conversations. As always, I'm your host, Guillermo, and as always, I'm not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So yesterday we took a look at put credit spreads. If you have not watched that video, I highly encourage you to go do so. I'll put a link to it in the description below. But today we're going to be talking about call credit spreads. Okay, and so you'll be able to see what the differences are between those and when you might want to do one or the other. Now, if you're new to trading options, I've made a couple of videos where I discuss this in more detail. I'll also put links to those videos in the description below. You should go ahead and check those out, or else none of this will make much sense to you. Now, I just want to clarify something again. By default, Robinhood will have trading options and buying and selling spreads disabled. They do this for your own good because if you don't know what you're doing, you could potentially lose a lot of money. So it's kind of just to make sure you're safe. But to enable it, all you got to do is go into your settings and then go to the options trading section and then just enable it. Now keep in mind, depending on what level you're on, not all of these will be able to be enabled. Okay, buying and selling spreads might not actually be enabled for you. So in order to get it to be enabled, you just have to have more experience with just the regular buying calls and puts, selling calls and puts. But eventually, when you're able to enable it, you'll see something down here that will say enable buying and selling spreads. You'll just click on that button and you'll be all set to go. Now, before we begin, guys, please let me know where you're watching this from. It's always exciting to see how far across the country my videos are reaching. I know last time I saw someone mention that they were from England. So let's see if we can go out farther than that even. So thank you guys very much for your support. And as always, remember to smash that like button and subscribe, guys. We are over 3,000 subscribers, so thank you very much. So for this demo, we're going to use American Airlines again, since I did use that for my put credit spread video. And so hopefully this can help you guys follow along even better and not cause so much confusion if I'm using a different stock. Now, before we begin, I just want to say, so when you're doing a put credit spread, okay, that is a bullish strategy. When you're doing a call credit spread, that is a bearish strategy. So if you believe that the price of the stock is going to stay the same or go down, you want to do a call credit spread, right? If you think the price is going to go up, you want to do a put credit spread. So let's take a look here at trading American Airlines options again. So we'll just start off here. So again, as the name suggests, right, call credit spread, we're going to be dealing with calls. And it's going to be the exact same concept. We're going to sell a call and we're going to buy a call. And again, we're going to do this to minimize our risk, but again, you're also going to minimize your profit. And so we, for just a quick refresher, right? So when you sell a call, right, and let me just actually use an example. So if I were to sell this call right here with a $17 strike price, what this would be saying is if the share price of American Airlines goes above 17 on or before the expiration date, then I would probably be forced to sell 100 shares of American Airlines at $17 a share, right? Now, for doing so, I would receive $1.31 per share, and since there's 100 shares, I would receive $131 credit. And in contrast to that, when you buy a call, right? Let's say I were to buy this call right here at an $18 strike price. What this is saying is if the share price of American Airlines goes to $18 or above on or before June 19th, I can decide if I want to. I have the right, but not the obligation, right, to purchase 100 shares of American Airlines at $18 a share. And for doing that, for buying this, I would have to pay 92 cents per share. And since there's 100 shares, I would pay $92, right? And so when you buy a call, you're hoping that the price of the stock goes up. When you're selling a call, you're hoping that the price of the stock stays the same or even goes down a little bit, right? So you can, again, see how those two things are the exact opposite of each other, and that's what's going to help you minimize your risk. And so, again, we'll go over to our options profit calculator. Again, this is very helpful to help visualize what is happening. And you'll see here the graph that we get, can show you what your profit or what, how much you're losing on what day looks like. Okay, and so helps you determine whether or not, a call credit spread is, what you want to do or not. So again, we're going to go into the spreads category and we're going to click on call spread. So here's a call spread calculator, okay? So again, it's very easy to use. So the first thing you got to do is you go into this underlying stock symbol. So you have a symbol, and we're going to say American Airlines, which is AAL. That's the symbol for it. So we'll get the price, and then it'll populate what the price of that is, which is 1674 right now. And so again, right, we're going to start by selling or writing. So those two things are the same, a call, and then we're going to buy a call as well. So let's go ahead and sell a call. So you click on select option here, and then you get this little graph here. So again, up here you can choose your expiration date. I'll just leave it as June 19th. And so then over here on the right you have your puts, but we're not doing puts. We're going to deal with calls this time, so we're going to stay on the left here. So there's a call. So again, the price of American Airlines is $16.74. And so we'll just use 17 because that's what I used here not too long ago. So we'll say that we're going to sell a call at a $17 strike price. And as you can see, we're going to receive $1.30 per share. And since there's 100 shares, we're going to get $130 credit, which is what you see here, right? The total cost is $130. Now, so this is what this is saying, right? We're going to sell a call that expires on June 19th for a $17 strike price. So this is good, right? But the issue with this is if you don't have 100 shares of American Airlines, right? And let's say that the price of American Airlines just shoots up to, let's say, $20, right, before June 19th. The problem with that is if you don't have 100 shares yet, is you're going to be forced to buy 100 shares of American Airlines at $20 a share. But then you would actually have to sell them at $1,700, right? Which means you would lose $300. And in fact, your loss here would be infinity because theoretically American Airlines could shoot up to, $1 million, right? And then you'd have to buy 100 shares at $1 million per share, but then only sell them for $1,700. And so that's the risk involved here, right? Now, thankfully, on Robinhood, or at least as far as I know, you need to have the 100 shares first in order to even sell a call. But I know there's some brokerages where you don't need to have 100 shares, and so that can be really risky, right? And so in order to minimize that risk of American Airlines just shooting far up, what you're going to want to do now is buy a call. Okay, and you're going to see how that minimizes the risk. So if we go up here to buying a call and we select an option, so we want to buy a call where the strike price is a little bit above, or I guess it could be as far above as the call you sold strike price as you want it to be, but the closer it is, the less risk. So we'll use this $18 strike price for buying the call. And so as you can see for this one, I'm going to have to pay 91 cents per share, and there's 100 shares, so I'm going to pay 91, okay? And so since I sold this call for $130, but I bought this call for $91, my net profit here, the most I can make would be 39 cents per share or $39, right? And so again, you can kind of see that the risk is going to be minimized, but also your profit is going to be minimized as well, because before I could have made $130 just by selling a call, but now I'm going to have to buy a call as well to minimize the risk, and it's going to reduce how much I make. So if you click on calculate, right, you can actually see what's happening here. So as you can see now, your maximum risk is now $61, and that's going to be happen at a price of $18 at expiration. Your maximum return is going to be $39, like I mentioned, and that's going to be at $17 at expiration. Okay, and so again here, if you look at the graph, you can kind of see how this is a bearish strategy, right? Because as the price goes down, I mean, you're good, you're making money. When the price starts to go up, you're losing money. And so let's kind of think about the three different scenarios that happen here. Let's start off with the first scenario, right? What you want to happen. What you want to happen is that these contracts expire worthless, right? And by that I mean that the price of American Airlines on or before June 19th is under $17. Because if you go up to the date of expiration, and so if we look at 17, you're making that $39, right? Which is a max return. And if you go all the way down, you're making 39, 39, 39. So you want the price of American Airlines to be under $17. That's the best possible outcome, right? So both of these contracts expire worthless. Now keep in mind, anywhere that you're in the green here, you're making a profit. And so always remember that you can exit an options trade at any time. And so, if you're here, let's say on June 16th, and the price of American Airlines is 16.30, you've made a $7 profit. And if you think that the price is going to shoot up the next day to 18, you can just exit out right there and make some profit. So keep that in mind always. But anyways, as you can see, you're going to make the most profit if it's at $17 on expiration or below. Now, if you start to go up, right, you can see you start to lose money. So if it were 17.10 by expiration, you'd only make $29. If you go up another 10 cents, you'd only make $19, right? And so let's talk about what happens in between here, right? What happens in between here? Well, what's going to happen is, let's say it ends at 17.50 on the date of expiration. So let's go look at what that looks like. So on $17.50 on the date of expiration, you've lost $11. Okay, so where does that come from, right? How does that number happen? Well, it's very easy, guys. Look, so if it's 17.50, right, it'd be in between both of these. So this would still expire worthless because it never reached 18. But what would happen is you would buy 100 shares at 17.50, right, which would be $1,750. But since the price went above the strike price of the call you sold, you would probably be forced to sell 100 shares at $17 per share. So you'd be spending, you'd sell them for $1,700, but remember you ended up paying $1,750. So it's a $50 loss. But remember, you always get this credit of $39. So 50 minus 39 is 11. And that's where that $11 comes from, right? That's where you're losing the $11. And as it gets closer to 18, you start to lose more and more and more until eventually it hits 18 and you've lost 61, which is your most, right? Because what happens at 18 is once this reaches 18, what this allows you to do, remember, is you have the option to buy 100 shares at $18 a share. And that's what you would do. You would buy 100 shares at $18, so you would spend $1,800. But remember, you're gonna be forced to sell the 100 shares back at $17, so $1,700. So you'd lose $100 there. But again, since you made $39, 100 minus 39 is $61. Okay, and you can actually expand this graph farther up and down to actually see that this is your max loss. So if you go to this graph range, right, you can go like 15, and then we can put the higher end at like 19, calculate. And you can see here that, so the numbers showing here are the percentages. And as you can see, once it reaches 18, it's 100%. And anything above that is always 100%. So again, the amount that you can lose here is capped off at $61. And then over here, right, it's $39 is the most you can make. And so you can kind of see here the way this would play out. And so you can come in here and, just mess around with these, make these, make both of these contracts farther apart and see how much your, how much the risk increases, how much your return increases or decreases, things like that. So this is a very helpful tool. I definitely recommend you guys go out and just play with it, right? Especially if you're going to be doing spreads. First, mess around with it and try to understand what the best risk to reward ratio is, right? So now let's actually go back to Robinhood and try to create that exact same transaction, right? So again, we were using the expiration date of June 19th, which is already set here. So we can go to sell a call. And remember, we chose this $17 strike price. So all I got to do is click this little plus button. And then we're going to buy a call. And for that one, we use the $18 strike price. So we're going to click here. Okay, and so again, right away, you can see that it populated. It understood this to be a call credit spread now. And again, here's the 39 we saw over there, 39 cents per share times 100. You're going to make $39, which again, you're going to get instantly. And so you can decide how many contracts you want. Usually people only get one, but you can get as many as you want. And So here's the limit price, right? Remember, you can try to go for like a higher limit price. I mean, I could attempt to ask for 41 cents per share and $41. This probably most likely wouldn't go through. Usually they want something in the middle, and then you can review order. And so again, you can see a couple of things here, guys, like I've mentioned before. Uh, right, you're gonna buy to open a call at an $18 strike price that expires on June 19th, and you're gonna sell to open a call at a $17 strike price that expires on June 19th as well. And remember, guys, you're always putting up collateral for these credit spreads. And as I mentioned before, to calculate how much collateral you're going to need to put up, all you got to do is subtract the strike prices of the call you sold and the call you bought. And so if we subtract 17 from 18, that's 1, and then you multiply that by 100. Okay, so yeah, that's how much collateral you're going to put up. So if for example, if we were actually going to buy to open a call with a $19 strike price, you would subtract the strike price, so 19 minus 17 would be 2. You multiply that by 100, that'd be $200. That would be the collateral that you would need to put up. Okay, so it's very quick and easy to do that math. And then remember, you're going to receive $41. But again, this probably wouldn't go through. They'd probably want like 38, 39 at most. And then you would submit it, and you would have your call credit spread. So I hope this makes sense to you guys. I know some of you guys still have a lot of questions from the put credit spread. Maybe I'll make a Q&A video on both of these once this video comes out and you guys have any questions about it. But anyways, let me know what you guys think. Let me know if you guys are, doing call credit spreads or put credit spreads. I'm interested to find out how many of you guys actually do these. And as always, guys, if you have any questions and need to reach out, the best way to get a hold of me is through my Discord. I'll put a link to it in the description below. Go ahead and check it out. Also, if you plan on using Robinhood in the future, feel free to use my referral link, which is also in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is free money in both of our pockets. So let's help each other out. And as always, guys, hope you guys have a great rest of your day. And I'll see you guys next time. Thank you for watching.